Okay, students, this is Tuesday night. I'm going to go through and I'm going to solve those three problems that I gave to you. And I'm going to start with the easiest one and go to the hardest one. So the easiest one is actually 3. Okay? Because our sales price is $50,000. Our adjusted basis is the 110. The original purchase price minus the depreciation taken of 30 gives me $80,000 basis. Gives me then a section 1231 capital loss. And that's the easiest one. If look at your chart, if there is a loss, we don't remember all those 4 up above are only if we have gains. If we have a loss, we go straight to the bottom, this 1231 loss, capital loss. Now the difference between section 1231 and a capital gain property is section 1231 property is section 1231 property is real or depreciable property used in a trade or business held more than 1 year. Real or depreciable property used in a trade or business held more than 1 year. So it could be just the land that my building is sitting on is still going to be section 1231 property because it's real property used in a trade or business held more than 1 year. Capital gain property then is this investment type property. So if I have a rental house or an apartment building, those would be examples of capital gain property. Stocks, bonds would be others examples of capital gain property. So this is trade or business, and this is production of income. Okay, so this is our simplest one. Example number 3 then is our simplest one. This scenario in which I sell for less than the adjusted basis in the property. Okay? The next easiest one is number 1. Okay? Again, we need to do this same calculation. My adjusted basis is 80,000 minus my depreciation of 30,000. So my adjusted basis is $50,000. Okay, so my sales price now is 100,000 minus my adjusted basis of 50,000, then gives me a $50,000 gain. Okay, so this is my total gain. So now if this is personal property, we start with section 1245. Now remember, the definition of section 1245 is the lesser of my realized gain or my depreciation taken. Well, in example number 1, my gain is $30,000, or my depreciation is $30,000. So of this $50,000 gain, $30,000 is section 1245, and $20,000 then is my section 1231 / capital gain. Okay, this is if it's personal property. If it's real property of an individual, we're going to still have my same $50,000 gain. but now we're going to start with section 1250. Now, look at number 1, my excess depreciation amount is my $10,000. That is the depreciation I've taken of 30 minus my straight line depreciation amount of 20. So that $10,000 is my excess depreciation amount. That's my section 1250. We go down the line, my unrecaptured section 1250 amount then is going to be this straight line depreciation amount. Look at your definition. It's going to be this $20,000. And then my same section 1231 is going to be then this remaining $20,000. Okay? Now, if it's real property of a corporation, owned by a corporation, we're still going to have this same $10,000 section 1250. Definitions are the same, so the number's going to be the same. Remember, we're going to take this for section 291. Remember, it's this amount times 20%. So this is $4,000. And my section 1231 / capital gain is what's left. I think that's $36,000. Well, let's check it. It's this 20,000. The same 20,000 here, plus 80% of this. Because remember, we've taken care of 20% in this 291. The other 80% is going to be section 1231 or capital gain. That's $16,000. Total of $36,000. Okay? Now then, just so you understand the taxability on each one of these, this is ordinary income. This is taxed as capital gain. Section 1250 is ordinary income. This is taxed as capital gain, but it's kind of a hybrid of capital gain. It's taxed at a maximum tax rate of 25%. 1231 taxed as capital gain, section 1250. 291 again is taxed as ordinary income. All right, so that is scenario number 1. Now then, scenario number 2. Oh, let me just show you some things. This $20,000 gain, the reason I say that this is the easier than number 2 is this $20,000 is the same as the difference between my sales price and my original purchase price. This is the difference between my depreciation taken and my straight line depreciation. This is my straight line depreciation amount. And again, this is the excess. That's why I say that this one, all the numbers just pop out at you. There's really no thinking you have to do. Scenario number 2 is the one that's more complicated because then we have to compare those definitions, looking at which one produces the lesser of. So, again, my adjusted basis here, my adjusted basis is the 110 minus 30. So my adjusted basis is $80,000. Now my sales price is $100,000 minus my adjusted basis is $20,000. This then becomes my total gain. Well, the depreciation I've taken is $30,000. So remember the definition is this section 1245 gain here is equal to the lesser of my recognized gain, $20,000, or the depreciation I've taken, $30,000. So my recognized gain then is going to be $20,000. Okay, so now if this is real property of an individual, again, we still have the same $20,000 gain, of which, first of all, section 1250 is going to be, again, the excess depreciation amount, which is my $10,000 again. And then my unrecaptured then is going to be the remaining $10,000, and that's all. Okay? If it's real property of a corporation, still the same $10,000 of section 1250. This $10,000 times 20% is going to be my $291, which is $2,000. And what's left is going to be section 1231 / capital gain of $8,000. And that's it. That's scenario 1, 2, and 3. Those are the only three possibilities. Selling it for more than original purchase price, selling it for lower than basis, which is number 3, or selling it for greater than basis but less than the original purchase price. And that's it. That's the only three possibilities. They all cases have to fall within those three scenarios. The only other thing that could happen, recall from chapter 10, is all your depreciation tables for real property are basically straight line depreciation. So the only time that you would actually have section 1250 recapture is really old property before about 1990, placed in service before 1993. Other than that, it's all going to be straight line, and so you're actually not going to have any excess depreciation amount on property placed in service after 1993. And so you're just going to go to those others. All right. That's what I wanted to cover in chapter 11. I think everything else in chapter 11 is pretty much self-explanatory. I want you to pay attention. The section 291 stuff that I talked about is not in your textbook. So that's new material that is not actually in your textbook. All right. Chapter 12 is about like-kind exchanges. And involuntary conversions. Remember, going back to chapter 2, we talked about this concept, wherewithal to pay. That if I didn't have the wherewithal to pay, then I shouldn't have to pay taxes on money that I actually didn't have to pay. And this wherewithal to pay concept is directed almost exclusively after these involuntary conversions and like-kind exchange ideas that we're going to talk about here today and tomorrow. How much time have we gone?
We have 14 and a half minutes right now.
Okay. All right. So when we do either of these two, we got to enter into a 3-step process. Number 1, determine realized gain. And my realized gain is going to be sales price minus my adjusted basis. Number 2, determine recognized gain. And that is going to be lesser of number 1. By number 1, I mean this number 1 here, or boot received. And boot is defined as non-like-kind property. So if you and I exchange land and I give you a hunting dog in addition to the land in order to make the values equal, that's boot. If I give you a car, that's boot. If I give you anything besides the like-kind property, that's boot. And we would have to pay taxes on the lesser of 1, my realized gain, or the boot that I received. Number 3. Determine basis in new property. And that is going to be fair market value of new property I messed up. I missed a step. So let's try this again. Step number 3 is determine deferred gain. Which is going to be 1 minus 2. 1 minus 2. 4 is determine basis in new property. Which is going to be fair market value of new property minus 3. This 3 right here, minus 3. Okay, so that's our 3-step process. So let me give you an easy example. We have A and we have B. And they both have property and they are going to exchange them. So we're going to use fair market value. Let's see. Choose 100,000 and 100,000. This is our simplest example. And basis is 50,000 here and 80,000 here. So now we're going to work through this 4-step process. Number 1, realize gain. Here for A, that is $50,000. Here it is $20,000. 2, recognize gain is going to be 0 and 0 because there was no boot exchanged. 3, deferred gain is going to be 50,000 minus 0, or $50,000 here, and 20,000 here. Okay? Basis in new property is for A got B's property, so it's 100,000 minus my deferred gain of 50,000, so my basis is 50. And here we're going to do the same calculation, 100,000 from A minus my deferred gain of 20 is we're going to get 80. And you see that's simple. All we have is we have an exchange of these two assets, but everything else stays the same, including my basis. Okay, so far so good? All right, I want to give you one more example and then we'll call it quits for tonight and finish this tomorrow. Okay, let's say now here that this property is worth $120,000. So, A is going to get $120,000 worth of stuff, but he's only got $100,000 here. So this is boot given. A is going to give $20,000 worth of boot. B is going to get boot received. This becomes important. Remember our definition of recognized gain. My boot received now is $20,000. Okay, so again, number one, realized gain, 50,000 for A, 40,000 for B. 2, recognized gain. Sorry, this was realized gain. I might have misspoke. These are my realized gain. 2, my recognized gain is for A at 0. A gave boot, but A did not receive boot. Okay, for B, it's $20,000 because B received $20,000 worth of boot here in order to equalize the values. Okay, 3, my deferred gain here is $50,000. Difference between those two numbers. And $20,000, which is the 40 minus the 20. And for my basis in my new property now is going to be the 120 minus my deferred gain of 50, or $70,000. Now, think about this. This $70,000 is this $50,000 of original basis he had, plus this $20,000 of additional cash that he put in. Over here, it's $100,000 minus my deferred gain of 20 to give me a basis over here of 80, and it is no coincidence that this matches my original basis in my own property up here. Okay, so just as a preview for tomorrow, let me give you 2 additional rules. 3 additional rules. Number 1, that if I give up my mortgage, in other words, I have a mortgage on my property and you take my mortgage on, that's the same as me receiving cash. That's boot. Me getting rid of my mortgage is the same as receiving boot, and it's considered boot. That's number 1. Number 2 is that if there's an exchange of mortgages, I have a mortgage, you have a mortgage, we exchange mortgages, we can offset those two mortgages in calculating who got the net boot, who got rid of the most loan. Okay? And finally, if I give cash, I can use that cash that I've given to offset any mortgages, any excess mortgages I receive. But if I receive cash, I cannot use my mortgages as offset. Okay? So to say it another way, if I receive cash and give up a mortgage, I can offset the two mortgages, but the cash I cannot use as an offset, and therefore I'm going to pay taxes on the cash then that I received. All right, and we'll cover those last two scenarios then tomorrow with my lecture tomorrow, and then we'll go on and we'll start with the homework then in chapter 11. I think we're in good shape to finish 11 and 12 for this semester. So, all right, I'll talk to you tomorrow. Good night.